Good morning, good afternoon, wherever you might be coming to us today to learn about 1031 exchanges. The purpose of this video on our website here is to give you the basics of a 1031 exchange, what it is you're to expect, what next type of questions. But it's not to be a super deep dive, it's to be just a high-level overview to help you out, because I do understand that this law can be very taunting and confusing if you try to do your own research. So hopefully this will help you get started about what the process really is with a 1031. So to start off, again, my name is Doug Blackwell. I'm the CEO of 1031 Tax-Free Exchange Solutions. I've been in the business over 22 years doing 1031 exchanges exclusively. And not to impress you, not to try to brag or boast, just let you know that I've seen quite a bit in this business, and every time I think I've seen it all, something new pops in. But here's the process. The first and most important thing you have to do is contact a qualified intermediary or your CPA, such as myself, that can help you understand what you're about to get involved with a 1031. We can start an exchange the day before you close a property you're selling, but we must be involved prior to the close of escrow of any property that's bought or sold as part of a 1031 exchange. So timing is really important, or planning can be very important. We've opened exchanges the day of close. We certainly can do that, but in this presentation you'll see that can actually be a little detrimental in your timelines as they come in. So I'm just going to start off with, first, you must be engaged with us prior to the close of escrow, which takes a couple of days. If an emergency status, we could do it quickly, but we'd like some time. The actual process isn't that confusing or hard, but you can make it very complicated for yourself if you don't have proper planning. So contacting us early is really important. So with that being said, the way it works is you will engage us with a 1031 exchange. You'll ask us to do the business. We're insured. We're carried a massive insurance to make sure your accounts are safe and that what we're doing is appropriate for you. But most importantly, what a 1031 exchange is for is that the law states that basically no taxes or gains or loss or taxes on realization of gain is done with a 1031 exchange, because you can't touch the proceeds from the sale. That's the trick. At the close of escrow of the property you're selling, you can't receive any money from that in your account. We have to do the transfer for you. That's what the intermediary is for. We're also called facilitators. We're also called 1031 exchange people. But at the end of the day, to understand, we're involved in that process only. But it's going to sound like we're kind of like your tax advisor and your legal advisor as well, but we're not. We're simply here to help you facilitate the 1031, and our only really role is to move money from point A to point B for you to buy real estate. But as a disclaimer, we are not in the business of providing tax or legal advice. It's simply coincidental to the business we do. We always recommend you check with your tax or legal advisors if there's any question or concern you have, because we don't know your entire picture. We only are focusing on what's happening today and what you're trying to accomplish with this 1031 exchange. The 1031 exchange is done for many, many reasons, and I'm going to cover a lot of different things in this 20 to 30 minutes we're together right now. So you just give us a call if you have any questions about what might be happening. Again, the 1031 exchange is designed to defer the taxes on the sale of a highly appreciated property where you would normally pay those taxes and lose the ability to reinvest that capital. As long as the property you're selling for the 1031 exchange was held for investment for a period of time and as an investment, and the property you're going to buy with this money is going to also be held for investment or productive use in a trade or business. The timing of this is actually very interesting. They say for a qualifying period of time. That really hasn't been defined by the IRS, but I will say that, to be conservative speaking, if you've held the property for at least 2 years, 24 months, and it shows up on 2 tax returns as an investment for you, more than likely it will qualify. And the property you're going to buy, again, if you're going to hold it for more than 2 years, you're probably going to be perfectly fine for investment. But what if it's less? That's where it gets to be a question. We recommend at least a year and a day. And your CPA may say otherwise, but if it's less than a year, let's have a conversation. Not that it's disqualified, it's just we want to make sure that it's going to be okay for you to do the exchange without getting into blind, just dealing with something that won't be qualified later that they'll disallow. So less than a year, contact us and talk about it well before you do it, at least a year and a day. And if you're over 2 years, you're probably going to be okay. So again, the taxes that we're deferring are the gains and the depreciation recapture. And what that could mean is tens of thousands, if not hundreds of thousands of dollars of extra money available to you to reinvest into new properties to continue growing your empire or your real estate business. So with that, the taxes we're talking about are varied from federal and state. The federal taxes are 3. not just one. Most people think it's just a 15 or 20% capital gains rate from the feds that we're trying to avoid. It's not. There's more. So that's the first tax, the capital gains tax. The second tax is going to be on basis on depreciation recapture on the property that you sold. Again, it's a business asset. So the huge benefit of owning real estate for investment, obviously, the income you derive from that investment is very tax efficient due to the fact you can depreciate the asset over time, allowing you to get tax efficient income. However, it's depreciation. When you go to sell the property, it didn't depreciate, it appreciates. So the government likes to say, well, we're going to recapture that at a 25% flat rate. So again, it's about that number. There's also a federal tax called net investment income tax. That's a 3.8% tax on the capital gains based upon also your income levels at the time you do the transaction. Most people in a 1031 with a sale of a highly appreciated piece of real estate qualify for the 3.8%. And then you have the state, depending on what state the property is located in, of what tax you're going to pay the state. I just like to say, if you're really worried about this, talk to your accountant, talk to your CPA what the check would be you would have to write if you sold the property and didn't do a 1031 exchange. Pretty simple. You'll get a straight answer and right to the point. But if you want just a general idea, if you held the property any number of years, it's going to be pretty significant. And typically running between 23 and 40% of the gain is going to be lost to taxes, otherwise not knowing that number. So again, the interesting thing is, if you're really worried about the tax and you're doing a 1031 exchange and you follow the rules I'm about to go over with you, there's not going to be any tax, so not to worry too much about that. So that's our job, is to make sure that you follow the rules and to make sure that we do the best we can to make sure you follow the rules, but we can't guarantee that. And we can't dictate law. We're not lawyers. We're not going to say what you can or can't do. We're going to say what you should or shouldn't do. And in that respect, again, it's about talking with your tax and legal advisors if there's ever any questions about what's happening. So what is a 1031 exchange? It's the deferral of tax, not the elimination of tax on the sale of a highly appreciated piece of real property, because we can only exchange real estate, real property held for investment or productive use in a trade or business. Several different types of exchanges. We have deferred, we have delayed, we have simultaneous, we have reverse, we have build to suit, and there's a non-safe harbor version as well. Again, I'm not going to cover non-safe harbor because, again, it's outside the realm and the very small percentage of our business, not to confuse you with what's going on. Most of our exchanges are delayed exchanges. You're selling a property and then buying a property later. There's a reverse exchange where we buy the replacement property first and sell something later. You can't buy that property. You can't already own something for a 1031 exchange. We have to hold title for you for a period of time while you do the sale of your piece of real estate. We'll cover that in this presentation. So what the 1031 exchange is not for, we can't do it for fix and flips, and developers typically can't do 1031 exchanges either. They're buying property for the intent of reselling and not actually reinvesting. They're reselling. It's inventory to the IRS. They're dealers. So with that, we know that what are the taxes again? It's a lot. There's different taxes for different things that we're doing, and the state rates vary upon the state we're dealing with. Just realize that all the taxes will be deferred if you follow these few simple rules. And the rules start out basically say that the property, when you sell it at the time of sale, has been held for a period of time. We like to hear 2 years, at least a year and a day. And if less than a year, we want to talk to you about it to qualify for the exchange. And your intent is to be an investor. You're not going to use it personally. Primarily, it's going to be held for investment. So that also is going to be for a period of time. So, at least 2 years, if not, at least a year and a day. And if less than a year, you're planning on holding it, we need to talk about that because we don't want to disqualify you in the back end of this transaction later on, saying that you want to buy the property to eventually just resell it to a family member or something like that. So at that point, it's very important to know your intent. That's really what it's about. Your intent when you do this exchange is for investment, but we know that things change over time. That's the problem. We don't know that if you know something's going to happen down the road that you're doing this. The IRS simply wants to know that your intent is to continue being an investor and moving this asset to another asset class of at least equal or greater value that you're going to hold for a period of time. So the seller in this transaction, this is what's very important, must purchase what's called like-kind property for this 1031 exchange. That's a confusing part. What is like-kind in a 1031 exchange? If I sell a single family, do I have to buy a single family? If I buy income producing, do I have to buy income producing? It's very simple. Like kind is defined as real estate held for productive use in a trade or business or for investment. It could be commercial, it could be residential, it could be land, it could be a house, it could be a duplex, it could be a shopping center. It could be oil rights, mineral rights, water rights. As long as it's declared as real property, it could be exchanged. And that's important to know because it's not just a single family for a single family. It could be a single family rented out to someone as an individual to buy a mixed use property. I'm going to talk about mixed use properties on another segment. You'll want to look in our video library for mixed use. There's a lot of mixed use properties that are happening in today's marketplace. So the same taxpayer, this is one that kind of comes to bite people. The same taxpayer that sells must be the taxpayer that buys in a 1031 exchange. So if I sell, I probably should buy. If my wife and I sell, my wife and I should buy. If my LLC sells, my LLC should buy. If my corporation sells, my corporation should probably buy. Here's the interesting part. These entities can be changed and interchanged depending on the state and the situation it's set up as. For example, a disregarded entity, an LLC with just one member in it, and disregarded for federal tax purposes, can change name and title for it as on the buy side. But remember, keep it simple. Same taxpayer that sells must be the same taxpayer that buys. We're going to talk about partnership interests on another segment. When a partnership sells and the partners want to go separate ways, there's ways to take care of that. But unfortunately, it must be done before the close of escrow on the property you're selling or buying as part of a 1031. So again, proper planning should be taken into consideration. Always call us to talk about these things. But the same taxpayer that sells must be the same taxpayer that buys. The rules for successful change, the seller should buy a replacement equal or greater value than what they sold. This is the number one reason exchanges fail, believe it or not. The seller must buy equal or greater value. So let's say, for example, we sell an asset, I'll keep it simple, at $550,000. It could be $50 million, but let's just use $550,000 as the gross sales price. There's some real estate commission, there's some closing costs, and there's some money you leave the buyer to fix things that they want to take care of for the property to be sold. So let's say that number works out to all the expenses are $50,000, meaning that your net sales price is $500,000 in this example. Now, your exchange, you should purchase at least $501,000 of real estate for a 100% tax-deferred exchange. Not complicated, pretty simple. But what if the perfect property shows up, it's only $475,000? Well, okay, that's fine. You can buy a smaller value property or lesser value. You'll simply pay tax on the difference of what you didn't reinvest. You want to make sure you at least cover your basis in the property that you sold. Basis is defined as your purchase price plus improvements minus depreciation over time. At least cover that amount, and you'll have a successful exchange. Now, understand this. Buying less means there'll be some tax, and some tax is perfectly fine. I'm okay with that. It's just a tax you didn't know is coming is what is usually the problem. So let's have the word the exchanges typically fail, and we have a problem. Let's say that very same transaction occurs at $550,000. All the expenses come in at $500,000, but there's also a $200,000 loan on the property that was sold. Well, obviously the loan is paid off at the close, and you're left with $300,000 of cash that comes to us for the exchange. Again, title sends the money directly to the qualified intermediary to be held in an account specifically for you. And you can't touch the money. So you go and tell your agent looking for a property, hey, I've got $300,000 in an account that needs to be moved, and it's a 1031 exchange. We got to get busy. I'll talk about the timelines. But importantly to know, you tell them $300,000. They ask you, do you want to have debt on the purchase? And you tell them, no, I'm just going to pay cash because that's all I have in the exchange account. So you go off and find the perfect property for $300,000. You purchase it. You high five, break bread, drink wine with your broker and or the person that found the property, and off you go. 2 years later, you get a bill from the IRS for a $200,000 replacement value that wasn't covered in this 1031 exchange. It was the debt that was paid off. They will tax you on the debt relief. Again, that debt relief could be significant because it might present no value to the exchange at all. It might represent all of the gain you had in the property. So again, that's why we have to be careful that we do the $500,000. You must reinvest all the cash proceeds from the sale and replace the value of any debt that was paid off as part of this exchange to come to that $500,000 number. Now, you don't have to have a loan to make this work. You can come in with $300,000 that we are holding for you and $200,000 of your own cash to make this work, as long as you buy $500,000 worth of property. You can have the seller do seller financing. You can buy 2 properties if you would like to. As long as you buy $500,000 worth of real estate in this transaction, you will have pretty much a zero tax bill for this transaction. Now, anything you receive as part of this 1031 that's not real estate is going to be subject to tax. It's called boot. Cash is, for example, is boot. You bought lesser value. Debt relief is boot. The buyer or the seller decides to give you cash at the close to fix things. Guess what? In your replacement property, that's boot. You're getting your money back. The seller decides to give you a car. A car is not real estate. Again, it's one of those situations where you want to be careful. Talk to your qualified intermediary what you're doing and make this work. What I always tell clients is this. Talk to your QI, qualified intermediary. Don't worry about the taxes. Just assume that there are no laws, there are no rules, there will be zero tax. You could take everything and put it in your mattress if you wanted to. What would you as an investor love to see this money do? Disregarding the tax part of this. That's the best way to handle a 1031 exchange. Therefore, you're buying what you really want, and you may pay some tax, but it also helps us help you maybe achieve some of those goals while still doing a 1031 exchange. I'll explain later, because here's the rules. Partial exchanges are allowed. We can don't have to reinvest everything. It won't blow the whole exchange, so we have some flexibility. Some closing costs, again, are eligible for this transaction, not all. So remember, one-time closing costs are fine. Title fees, our fees, closing costs, real estate transaction fees, your attorney, your law, your CPA fees. All these things can be wrapped up in this 1031 as long as it's paid through escrow on one of the properties. We can't send the money to any place but the title company or closing agent for you in this 1031 exchange. Again, there's lots of things we can do that make sense. You'll also read that seller financing or refinancing before or after an exchange is prohibited if you read on the internet. It's not prohibited. You just have to be careful. Again, refinancing just before an exchange, you might have to do that to fix the property up. Refinancing right after an exchange, rate and term is perfectly fine, or you find another property to buy. As long as the money's not being used personally for the refinance, you more than likely will be okay. If you wait 1 year after the exchange, you'll definitely be okay, and at least a different tax year than the year you actually did the 1031 exchange before the refinance often is acceptable. Just check with your tax advisors to see how comfortable they are with your situation. Again, I don't know your situation, so we want to make sure that everything is copacetic. So that's the rules for a 1031 exchange. But now we have the second piece. There's 3 pieces, actually. The tax is obviously the reason you do a 1031. The second headache is, of course, the rules you got to follow, all the same taxpayer and equal or greater value. But the third piece that drops are these crazy timelines. You're put under some pretty arduous timelines to make this exchange work, to follow the rules. The timelines are very simple. We, as the intermediary, must be engaged prior to the close of escrow so that you are not receiving any proceeds. The closing agent must be authorized to send the money someplace other than you. That's why we need to be engaged prior to the close. They then send the money to us. If they send the money to you, even if you touch it for a second, you have constructive receipt of the money. They can't even hold it in escrow for you because you have constructive receipt. It must leave their hands at the moment of close and go to a qualified intermediary. That happens before the close. We do them the same day. We don't like it, but we like to have at least 3 to 5 business days prior to the close. And typically we tell clients all the time, as soon as you get an escrow, an accepted offer and escrow opened up, that's the perfect time. Just check us off the list, because if your buyer decides to back away and don't close, we're not going to charge anything. Just check us off the list. But here's the magic. Once it closes, the timelines start. And they are like this. You have a total of 180 calendar days to complete this entire transaction. And it includes holidays and Christmas and all those different things, not your emergencies. 180 calendar days, of which the first 45 calendar days of that 180, you must let us know what it is you're going to buy as part of this exchange. You don't have to have a contract on it. You don't have to even contact the sellers yet. But by the 45th day, if you haven't let us know what you're doing, we need a list of properties on what's called an identification statement. You will get one of these at the beginning of the transaction. We don't need it back until day 45. We don't want to know every time you're making offers. We want to know when you have an accepted offer on something you want to buy as part of this 1031. And if you get to the 45th day, if you haven't got anything under contract, to let us know what it is you would like to continue working on at the day 45 to allow this exchange to continue. And here is the headache. After day 45, that list of properties you give us are the only ones eligible for this exchange going forward. In other words, day 46 on, the list you give us on day 45 are the only ones you can purchase as part of this exchange. Even if those properties get bought by other people or they become not eligible for your purchase, they're the only ones. So I tell clients all the time, by day 45, if you're not working on something, give us a list of properties you would like to continue working on if you want this exchange to continue. Again, if you want to just go ahead and fail it, just don't identify with us. If you forget to identify with us, it will fail the exchange. But at day 45, it's critical you work with us before day 45 to identify what you're working on is on that list to make it work. And there's different ways to do this because the list can't be modified after day 45. There are several ways to identify, and this is how I like to explain to our clients is how it works. The first is the most common you hear about is what's called the 3 property rule. You can identify 3 properties of any value, and it doesn't matter how much you buy. You could be selling for $1 million. You could identify $20 million worth of real estate. It does not matter, but you're limited to only 3 properties. And they must be unambiguously identified to us by address or legal description. It can't be the house on the southwest corner of Elm and 20. It has to be a physical address or a legal description. So at that, we know that, well, what if I want to identify more than 3? You can do that. It's called a 200% rule. To back up a little bit, the 3 property rule is perfect if you're going to sell one property and buy just one property with this exchange. That's the 3 property rule. If you're going to sell a larger asset and you have a lot of cash and you want to buy multiple assets, for example, of lesser value, the 200% rule works great. This is how it is. I sell for $2 million cash, no debt. I want to buy 4 duplexes, each worth $500,000. Obviously, you're going to identify more than 3. If you identify more than 3 properties, you will fall into the 200% rule, meaning you can identify as many as you want, but your cumulative value of everything identified doesn't exceed 200% of your gross sales price of what you sold. So if you sold for $550,000, you obviously could identify $1.1 million worth of real estate cumulative on that list. You don't have to buy all of it. You don't even have to have offers on it. But that's what's all you can buy as part of this 1031. Now, there is one last exception called the 95% exception. You can identify more than 3. And if you exceed 4, and it does exceed 200% cumulative value, that's fine. You must purchase 95% of what's on the list or the whole thing fails. Sounds arduous, but it's actually designed for portfolio sales, the purchases of many DST products, Delaware Statutory Trust, which we'll cover later on a different blog as you go to our website and learn about DSTs and multiple asset portfolios. So again, it's just a way to allow you more flexibility. Don't focus on any of this. What I want you to do is call us before the close and explain to us what you're trying to accomplish, and we'll try to guide you to which way makes the most sense so you're not wasting your time and energy, because that's all you really have is a little bit of time. Time is your friend, and time can be your enemy. Being your friend is saying, let's talk about this and do some planning. Not being so friendly is you tell me the day before close, you only have 45 days to identify something, so it gets pretty crazy. And again, we want to make sure that what you're buying is going to qualify for 1031 because there are so many options out there. Again, the conversion of property is so popular these days. In other words, I have a primary residence. It's worth more than my $500,000 exclusion. How to avoid the tax on that? I'll go over that under conversion of a 1030 of a primary residence. What if I have an investment property after a few years I've owned it, I decide I want to retire in a community that's different where I'm at right now, but I don't want to buy a place today. I can't afford, the prices have gone up so much. I want to own a property there for a number of years, maybe to retire there. You can move into an investment property and convert it. But if you did a 1031 exchange to buy it, you have to satisfy the 1031 exchange first before you convert it. It's really simple. Look at conversion as the next segment in our website. You'll enjoy that video as well. Mixed use properties are another very popular topic, and that could be as simple as someone selling the farm that they operate. They live on the farm. That's mixed use. It could be a duplex where you live in one unit of the duplex. It could be an apartment complex where you occupy two of the units as your home. We did a hotel worth, I can't remember the dollar amount, but they lived in two of the units for about 20 years with their family, and they had a huge storage facility in the back for their personal use. We were able to carve that out as their primary. It was a hotel. It got all kinds of weird reviews from the CPA. Didn't think they could do it. But as we explained to them, that was their home. It does qualify. Again, there's so many things. Also, another segment I want you to make sure you visit is Delaware statutory trusts. It's going to be a very popular topic, and I don't like saying for those that are tired of toilets, trash, and tenants. No, my clients love real estate. They love what it did. It made them wealthy. The 1031 exchange, I'm now working on third generation money, is created so much tax-deferred compound wealth. It's the perfect tool for everything they're doing. They're not tired of it. They're just saying, I need to throttle back. Look, I've got all this real property. I've got 1, 2, 3, 5 rental houses. I'm getting a little older, not older. I'm getting a little, I want to do something different. How can I convert these assets to income producing with no management responsibilities with a qualified asset for a 1031 exchange so that all of my money goes to work? And that's a Delaware statutory trust, among other things. We'll have a special guest speaker for that later on and to cover that topic specifically for you as an opportunity to review, because that is the entree to what's available to you. We have tenants in common products where you go straight to a developer or to a friend and buy a property together. Related party transactions, you want to visit that segment of our website, because many times our clients are thinking, how do we let our family benefit from this later in life? Because remember, we're deferring the taxes. We're not eliminating them. How to eliminate them? Unfortunately, when you pass away, they will be replaced with the estate tax. And whatever the estate tax provisions are at the time of your passing will dictate what kind of step up in value you can get, and depending on what state you're living in and how you have your estate set up. So estate planning is also very important if you're thinking about these types of things. We're here to help, but we can't guarantee these different types of things to happen without time to deal with it. The perfect time is now to have a conversation with us about what you're trying to do. Our consultations are complimentary, and we will never, ever try to give you legal advice that's dedicated to what you have to do. It's to give you the questions you need to ask your team what needs to be done, or at least to understand where you're heading in this direction. It's been a pleasure to be able to present this to you. I hope this helped you make a better decision on how to proceed with this 1031 exchange and kind of what the rules are. So thank you for listening.